Welcome to this explainer. Today, we're looking at a truly fascinating case study that sits right at the intersection of cutting-edge AI, blockchain infrastructure, and, well, raw market psychology. We're going to analyze the dramatic rise and the sudden, violent fall of a project called Unibase. By breaking down exactly what happened here, we're going to uncover some absolutely crucial crypto trading lessons. So, whether you're a seasoned trader or just trying to make sense of all this market volatility, there is just so much to unpack here. Let's get into it.
Okay, let's dive right in. Take a look at this staggering number, 294%. That was the massive weekly surge that recently propelled the Unibase token, or UB, straight to the top of the market gainers list. It was driven by this coordinated capital rotation and, honestly, massive hype around AI agent tokens. Unibase was literally the undisputed talk of the crypto market. Traders were popping champagne over new all-time highs, and the token was plastered all over Exchange Alpha reports as the standout performer. I mean, it looked like the perfect rocket ship, right? The kind that makes you seriously consider quitting your day job.
But then, total whiplash. In a brutal 24-hour window, that exact same token crashed by 23.4%, plummeting down to just over 5 cents and wiping out millions in market cap just like that. The trading volume absolutely surged, which points to intense, overwhelming selling pressure throughout the session. The euphoria just vanished almost overnight, leaving a lot of late buyers completely trapped.
So, this brings us to the core mystery of our explainer today. How exactly does a highly touted, revolutionary AI infrastructure project, one with, actual legitimate technological promise, collapse so violently in a single day? Was it a failure of the tech itself, or a failure of the traders? To figure that out, we first really need to understand what people thought they were buying in the first place.
Section 1. Giving AI a memory.
Now, the core value proposition of Unibase actually solves a major problem. See, today's AI agents are incredibly powerful, but they have a fatal flaw. They're fundamentally stateless. They're forgetful. When you end a session, they essentially forget past interactions and struggle to build up experience over time. But just like Ethereum revolutionized crypto by giving smart contracts a permanent state, Unibase steps in to give AI agents a verifiable, decentralized memory layer. It's taking them from these disposable, one-off tools and turning them into persistent digital actors.
To actually pull this off, Unibase introduced some pretty heavy technical architecture, specifically AIP 2.0. That stands for the Agent Interoperability Protocol. You can think of it like a universal translator and secure routing system for AI. It basically allows an AI agent on one platform to securely share its memory, verify its identity, and even handle payments with an agent on a totally different platform. And it does all of this without relying on a centralized database. It's really the foundation for what they're calling the Open Agent Internet.
And here's the thing, this wasn't just theoretical white paper talk. They were hitting real-world utility milestones. They integrated with the open-source Hermes AI, which allowed it to actually store experiences as reusable skills. Plus, they launched facilitators for ERC 8004 to give agents on-chain identity, and the X402 standard to let agents make gasless micropayments autonomously. Basically, they were giving your AI its own wallet, which is both amazing and, let's be honest, slightly terrifying. These were massive, tangible developments, and they were the exact fuel that drove that initial euphoric 294% hype cycle.
Section 2. Anatomy of a crash.
But, as we all know, great tech doesn't automatically mean a safe investment. Now, what's really interesting about this is the silent killer hiding in the project's tokenomics. Unibase has a max supply of 10 billion tokens, but only 25% are currently circulating. That means a staggering 75% of the supply is locked up. This creates a massive dilution overhang. So, while the market cap looked okay, sitting around $168 million, the fully diluted valuation was over $674 million. Any trader doing proper fundamental analysis should have seen this as a giant flashing warning sign. If those locked tokens start entering circulation, it heavily dilutes the existing holders.
And wow, when the selling started, it was ferocious. Uniswap swung from an intraday high of roughly 7.8 cents all the way down to 4.4 cents. That is a brutal 43% intraday swing. If you were one of the folks buying the breakout at the top, you were absolutely wrecked in a matter of hours, as early investors aggressively took their profits.
But here's the kicker. The warning signs were totally there if you knew where to look. Social media sentiment wasn't universally positive.
In fact, some sharp analysts were pointing out incredibly low liquidity pool values and warning that the project's smart contracts literally still allowed the team to freeze or mint tokens at will. This perfectly highlights a classic crypto dynamic. Overwhelming hype can so easily mask underlying manipulation risks, centralization issues, and the simple, undeniable danger of thin liquidity when a massive sell-off triggers.
Section 3. The FOMO and Leverage Trap.
So we've got a token with great tech, terrible tokenomics, and early investors cashing out. But honestly, that alone doesn't usually cause a 43% intraday swing. $10,950,000. That massive number represents the leveraged long positions that were completely wiped out, just liquidated in 24 hours during the Unibase crash. This wasn't just everyday people selling their spot tokens. This was forced selling triggered directly by the exchanges.
You see, right before the crash, a major exchange, OKX, listed Unibase perpetual contracts. This suddenly allowed traders to use 20x to 50x leverage. Retail traders, suffering from some severe FOMO, fear of missing out, borrowed money to amplify their bets on the token going even higher. But the second the price dipped slightly because of that early profit-taking, those over-leveraged accounts just couldn't cover their margins. The exchange automatically sold their positions to cover the debt, which drove the price down further, liquidating more traders and creating this rapid, devastating cascade effect.
Section 4. Mastering Crypto Trading Rules.
Let's move to and see how this builds our core lessons from this crash. The Unibase situation is practically a textbook on trading errors. Chasing that initial 294% pump, well, that's the classic mistake of FOMO and overtrading. Ignoring that 75% of the token supply was locked up, that's the mistake of ignoring fundamental analysis in favor of pure hype. And getting completely wiped out when the price dipped, that for sure is the fatal mistake of using way too much leverage on a highly volatile asset.
So, the crucial point is, to survive markets like this, you really need a structured plan. Step 1. Always manage your risk. Never, ever invest more than you can comfortably afford to lose, and absolutely use stop-loss orders to automatically cut your losses before they turn catastrophic. Step 2. You have to look past the narrative. Analyze the actual fundamentals, stuff like circulating supply, tokenomics, and team control before you buy into the hype. And step 3. If you are new to this or trading a highly volatile asset, start with low or absolutely zero leverage. Don't amplify your risk until you've truly mastered risk management.
Furthermore, successful trading requires strict, unwavering discipline. You need to trade with the broader market trend rather than trying to catch every single falling knife. Diversify your investments. Putting your entire portfolio into one hyped token is just a recipe for disaster. Accept that losses are a part of the game, remove your emotions from the equation, and never ever revenge trade to try and immediately win back the money you just lost. Protecting your capital so you can trade tomorrow is vastly more important than chasing a parabolic pump today.
Ultimately, as the Unibase roller coaster perfectly demonstrates, crypto trading is not about getting rich overnight. It is a long-term journey. The traders who survive and thrive are the ones who are patient, who stick to a defined strategy, who wait for high-probability setups, and who make consistent, data-driven decisions over time.
Unibase is trying to build persistent memory for artificial intelligence, making machines smarter, more calculated, and perfectly capable of following their programming without a shred of emotion. Yet human traders were wiped out by the millions because they abandoned logic for fear and greed. So it leaves us with this thought. In a market increasingly driven by AI, are your trading rules still human? Thank you for joining me for this explainer. Stay sharp and trade smart.